The day started off okay, and we built into some nice bullish momentum, but then the FOMC minutes came out with a little bit of a knee-jerk reaction and then a close lower. In fact, only the second time this month that we had a day where we had gains above 1%, but then closed lower by 0.5% or more. We haven't seen that happen since August 2011. I tweeted that out earlier today. I'm going to break down what that means, how that impacts our near-term expectations here going forward, and what that means for this new bullish intermediate posture that we just barely crossed above 50, and what to expect from that. So let's go ahead and get started. Today is Wednesday, February the 21st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. I'm glad you found us. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video. You can do that right now while you're watching. Also, hit that thumbs up icon that's right next to that button. That will let me know a couple things. Number one, tells me that you found something useful in today's video, that you found some value there, you liked it. Number two, it tells me that you want us to do it again tomorrow. Nice, easy way to give us feedback with one click. You can do that right now, again, like I said, while you're watching. Scroll down and comment on anything that stood out to you from today's video. You can see the comment section even further down below. And of course, join my daily email list I send out in conjunction with these videos, a time-stamped, hyperlinked summaries of everything we talk about in these videos. So to get that email, click on the link that I've highlighted down in the description below. Follow me on Twitter for more content just like this throughout the day, throughout the week. Remember to like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. And then finally, join the Market Outlook community. We're almost up to 900 people in our Facebook group. So to keep this discussion going with other people that are watching these videos daily, just like you are. All right, well, let's take a look at the S&P 500 with the market forecast tool. You can see that momentum line was bouncing out of the reversal zone after being oversold yesterday, showing this bullish intermediate confirmation signal, but falling to an extreme because we closed at the low with a relatively large range today. We closed right at, pretty much at zero on the momentum line. That's not a good sign for stocks. Now, again, it's not unheard of, and you come back up here and you can see the momentum line did during the beginnings of this bullish rally did come to an oversold level, just not to an extreme. So that's a little concerning in terms of how long this intermediate rally, which we just barely crossed above 50, what's the likelihood we're going to be able to keep it above 50 for very long? The expectations 1 to 3 months. That oversold momentum line would tell you we might not even make it a month. Without some kind of pullback here. The near-term line did avoid going into the reversal zone, so that's a positive sign. A development that if we were to hold support here at 2,700, you can see where that support is. It's 23% Fibonacci retracement of this rally, of the near-term rally that we just finished. All right, so there's some support there. You can see there's an old high point. It's the high of that near-term level here that we were looking at for that bullish divergence that we busted through late last week. So there's going to be some support. If we were to hold that support here tomorrow, fine. If we break below that support, we might pull back down into this 2650 to 2625 area, which obviously would be a lot more bearish than what people may be comfortable with. But again, wouldn't be significantly bearish considering the rally we've had. We've had almost a couple 100-point rally, over 200-point rally on SPY off of that low point there. So again, a pullback to 2650 would just simply be a 50% Fibonacci retracement. Market sentiment's dropping, but still at relatively high levels. Now getting to 70, and that's where we dropped down here during that decline. Wouldn't be surprised again. When the market sentiment tells you stock's path of least resistance, and right now, according to that line, again, that's only when it's between 20 and 80. When it's above 80, the path of least resistance is the upside, and same thing to the downside. You just don't expect very much upside because it's when you get above 80, you don't get very much, and that was kind of an anomaly compared to what we've seen in the past. Right now, since we are back between 20 and 80, and pointed lower, that tells us the path of least resistance is to the downside. Now that doesn't mean we have to go down like we don't have to trend lower. We can have down some, smaller down days and be more frequent, but with bigger up days. And you can see, again, over the last little bit, we had these 1, 2, 3, 4, 5, 6 down days since the market sentiment peaked really at the beginning of the month. We've had 1, 2, 3, 4, 5, 6, 7 down days with 1, 2, 3, 4, 5, 6, 7 up days. So about 50-50, which is a much smaller ratio of up days to down days compared to what we had over here when market sentiment was above 80 this whole time, or easily above 50% in that area. So, and of course, if we were to continue to pull back on a near-term basis, that ratio would drop below 50%. And again, that's kind of an expectation. Again, we would drop so much, we bounced so hard that we pulled up, here a couple hundred points so far, so fast, without kind of retesting support with a near-term low point, that you kind of think, okay, and we may pull back a little bit, significantly here. It may seem pretty drastic, but still hold. I mean, we can trade above 2,600. That's 100 points that we can trade within and still fit inside that range. I mean, we can go down to 2,550 and still hold the low point of that long lower shadow for support. So when you're that volatile, that's the kind, near-term runs can get bigger. And remember, volatility, even though it had dropped earlier today, and we'll see that here in just a second, is more elevated than it was ever over here in this area when we're getting such small daily candles. All right, we'll take a quick look at the Dow Jones Industrial Average and all the major indexes. Remember, the correlations, you've seen some of my tweets about the correlations are getting closer to 100%. So a lot of these indexes looking very similar to each other. Here we go with the Dow Jones. This near-term line did drop into the reversal zone. You can see starting to pull back a little bit there. Very similar looking chart to the S&P 500. Falling market sentiment. Intermediate line just barely getting above 50. Take a look at the NASDAQ composite here, and you can see it's hasn't pulled back as much. Look at the long upper shadows though, indicative of a potential near-term pullback. Its intermediate posture is stronger. It's bullish. It's rising. It's stronger. Its momentum line hasn't fallen as much. It's still above the 5th percentile. It's that 5th percentile that kind of tells us whether we are extreme or not. It is oversold and is setting up a bullish intermediate confirmation signal with that near-term line sitting between 20 and 50. So the NASDAQ actually has the best looking market forecast pattern. Now, it would be better if the intermediate line was above 80, then it looks really good. But again, consider inhaling and exhaling, right? There's a regular pattern of impulse moves and return moves. Impulse moves and return moves. There's our big impulse move, and this so far is the return move that produced that bounce pattern. That's not much of a pullback. In fact, you could say it's not even close to 23% Fibonacci retracement. Let's find it here. There we go. So you can see it's not even close there, and those long upper shadows are a little ominous from a technical analysis standpoint. And then finally, the Russell 2000. You can see yesterday it did hit an extreme low, closing below the low of the high day. We produced a new high day with today's range, but look at that long upper shadow again. That's just as ominous as a bearish standpoint as that was bullish on a bullish standpoint. You can see how we got a long lower shadow, held for support on the closing basis, dropped down below it, got a new, but again, held for support again on a closing basis here, new long lower shadow, both those really bullish, and of course the divergence pattern here, and then breaking up through those highs middle of last week. So as bullish as that was on a near-term basis at least, that's just as bearish, that long upper shadow there. So again, intermediate line crossing above 50, but that oversold momentum line, that extremely oversold momentum line on the S&P today and on the Russell yesterday, and these long upper shadows would suggest we may not stay above 50 very long on the. Now we might not drop back below the reversal zone. We might fluctuate a little bit because again, you've got some strong support in this area, but we may go back to a bearish posture here if we were to roll over and turn that intermediate line back below 50 really that quickly. Now, of course, we're just, what, 2 days into, well, 3 days with the holiday into this week. And we got an arrow again on the 50-day moving average. And we talked about that, as this MACD is really high and grinding lower, we'll start to get more arrows. We've seen this before. We'll see this again. That's why I'm not I don't think we'll bust through 2,600 anytime soon, which is about where the 200-day moving average will be in a week or two. We'll continue to grind here up and down above that 50-day moving average. It doesn't always have to be below it. We'll get arrows, right? We'll go up above it. We'll make a push below it. We'll go up and down. We'll push up above it, and we'll go up and down. We've seen this act play out before previously, and don't expect anything different this time. With the 3 green arrows, you can see we never did get back above the 30-day moving average. The 8 is still below the 17. So again, and if you're looking for some potential divergence, now I don't think we'll get down to lower lows here, which is what you would need. Now we might fill in, maybe we might get a close down to 25.50 where you would get a divergence on lower lows but still there's support at the bottom of that candle, right? And if that's the case, that MACD could form a higher low point. You see divergences all the time when we drop to extreme levels. You've seen also before when you look at the RSI, you can see how it got oversold there for the first time in a couple of years, right? And we have to go all the way back to November, the election, that the RSI got below 20. We were just at extremely high levels, and now, just like that, down, with a reading below 30, which doesn't, rarely ever happens. And again, a lot of times when you get these extreme readings, you'll get a divergence. So we'll see if that ends up being the case here. And again, the only way we do get it is if we get a close below that level that, but still holds that support down there, because that's going to be a significant support for the index if we were to continue this near-term pullback. And of course, you can see other indicators. CCI, again, a lot of times when you get moves below 200, you get divergences like you did there. You got a divergence there at that intermediate low point. This one, you got a dip below 200. You jumped right back up on the election. Over here, you got a little bit of a divergence. You dropped down, up. You went down to a slightly lower low there with a much higher low point. So we've seen this happen in the past. There's Brexit. There's the election there. No real significant news here, so that's why I'm thinking like the last intermediate lows that we've got, that we could definitely get another drop back down below negative 100 on CCI, but then obviously from a higher low point, which would have to again get below 25.75 on a closing basis before bouncing back up again. And that would be sharp move, but again, as long as we hold that low point there, that's fine. As you take a look at the pullback here today, and all of it coming after the Fed minutes, yield spiking, you'll see that more here in a minute. But you can see what that pullback looks like. We did dip below yesterday's low point, and you see how we got to the 23% Fibonacci retracement of this near-term run off of last Friday or 2 Fridays ago. The low on that Friday before we bounced up sharply there, almost 10 points on SPY, 9 points off that low. So pulling back down here again, you gotta have a pull. You gotta have these kind of pullbacks. You can't have every day an update. We've seen it already. It's not healthy, and it's not even healthy on a near-term basis. You're gonna get ups and you're gonna get downs, and we have to have the pullbacks to bring in more buyers on every new impulse for every new impulse move, especially when correlations are as high as they are right now. So you can see where there's going to be some support at 267. There's going to be another layer of support here, and you see how these Fibonacci lines just line up with old highs and lows. But right about 264 will be another layer of support there, and of course, you've got the whole 4-week range. That's why 270 is so important. You break through 270, that's the midpoint right now of the 4-week range. You get that back down below that, and we're starting to fill in a lot of this area, and of course, like I said before, the low point, the close is on that day is right there. Then you've got that long lower shadow, right? You opened here and traded down and closed up here, right there. So you got that body of the candles. All it is that distance there with all this long lower shadow, but that's the lowest close. So you can, anywhere in this area, 257.5, 255, you can close and produce that bullish divergence we've been talking about. Otherwise, I mean, that's kind of worst case scenario for the pullback. The best case scenario is you just pull back off here, form a higher low point, all the indicators form higher low points, and away we go from there. From a total range for the day and volume, see how the volume picking up at the end, still very light at 97.5 million for the day, so well below average. The trading range got bigger though after a 3-point range the last couple of days here, and we're back at almost 5-point range. So if you take a look at that on an absolute basis here, almost 5-point range, that's above this really high average, whereas the 90 million shares traded is well below the 4-week average. So again, as long as we're not up in this area here with volumes and trading ranges combined, that's when we're going to be more bearish. So I'll feel better about the bounce when we start getting trading ranges back in that 2 to 3 point range to start bringing this back down, and then the volume staying kind of where we're at to help bring that back down too. You take a look at the volatility index and you can see, we did dip down to 17.5 today before finishing the day back above 20. That's significant to me, and that's why I think we'll have a little bit of a near-term pullback here, a little bit more of a near-term pullback, because I think we'll bounce back up above 20 into this mid-20s area, 22.5 to 25, before finally forming this, the next peak. A lot of times when you get the spikes, we'll come down, come back up a little bit, form a new peak lower, and then break back down into. But like I said before, I don't think we're getting back down to the to the single digits anytime soon, or 10. In fact, I don't think we'll get back down there again this year. Looking here, and you can see we're on the relative basis, volatility is still right in the sweet spot for the bearish range, right? The bearish range being between 95% and higher, and the one point being the kind of the sweet spot for that. The bullish range is between 90% and lower, with the sweet spot being about 85%. So, we're kind of still, we dipped below today. We were back down into getting to the bullish area. Things would have been fine, but again, without a pullback, even a near-term pullback, it's hard to sustain, and we weren't able to sustain it on an intraday basis, much less, for more of a trend. And you can see we're right back up into the bearish range, back up to its sweet spot. Now, I don't think we'll spike back up again, because that's to get to these levels, it takes a spike. But can we get up to 110, get up to those extreme highs like we were below 80 for a while? Definitely can do something like that on a near-term pullback. So when you take a look at what's driving the action today, February 21st, and on a personal note, I have two older brothers. My second oldest brother, the middle one, with me, would be just turned 50 today. So I have two older brothers now that are older than 50 years old. Significant milestone in the family. So happy birthday to older brother there. But the biggest thing that came out today that affected the markets was the FOMC minutes. And you can see FOMC came out, no surprises, right? The idea, though, was how many rate hikes are we going to get in this year? The market had been looking for 3. They had set the expectations for 3 from the dot plots, right? So are we going to get 4? That's the big question mark. And if we get 4, we're looking at March, June, September, December. Well, you can see the odds of a rate hike in March now jumped up and are now, significantly higher than they were just a month ago when we were coming off of a prior meeting. And that's March, right? So that's one rate hike. Now we look at June, where we could have that second one for the year, and you can see, okay, the odds of that second, here's one. The odds of a second rate hike jumped up. We've gone from 54% up to 60%. So we're above 60%. So relatively high probability odds that we'll get 2 hikes by June, right? So now we say, okay, what about 3 or September? And you can see now the odds of a third rate hike in September are higher than just having 2 by September. And that's a significant change from yesterday, where the odds of just only having 2 was higher. You can see how that dropped down. And the odds of only 1 dropped down, and the odds of having 2 and 3 by September jumped up significantly. So 38 from 34 from a month ago. And then finally looking at December, where we could possibly get that 4th one, And again, from 19%, almost 20, up above 22%, you can see now we're starting to lose the odds of only having one or none here, or excuse me, one or two, of only having two by December. The odds of those are dropping, and the odds of having three stayed the same. And so the odds, the odds dropping here got basically put into the odds of that fourth one. So essentially, the market's saying we are more than likely going to have 4 rate hikes by the end of this year. And you look at how that impacted the major asset classes, well, you can see, first of all, the stock markets, small cap stocks, emerging markets started the day strong. Large cap stocks, pretty much U.S. stocks outpacing international stocks, with the dollar being strong, putting some pressure, relative pressure on internationals. But you can see bonds were down already before this Fed minutes came out. And so the dollar was strong, bonds were down, gold and oil underperforming. That was as of the meeting. Now you can see once the meeting came out, bonds actually jumped up. Stocks jumped up, pretty good. I mean, 3.3%. Dollar dropped 0.3%. So that's like right after. That was the initial knee-jerk reaction to the Fed, but that did not last long. As from that time that we hit this high point, really in bonds right here, everything dropped. Bonds plummeted. Stock prices plummeted with them. That's not typical, right? Typically, bonds prices and stock prices kind of move away from each other to a point where yields get so high that bond prices and stock prices start to move with each other, because again, bonds kind of lead the stock market there from that perspective. So stocks eventually will turn with them, and you can see, look at the dollar holding up, and that strong dollar pushing down gold, pushing down crude oil down 1%. And you can see even high yield during that. Remember how high yield didn't participate in that previous near-term drop on stocks? During this pullback here, high yield really held up strong. Well, that it's dropped this time. So this is more of a broader base sell-off than just overbought stock prices. Interesting to see the dollar in this trend. Was on this bearish trend. We talked about this idea of this bearish trend. We've got some room to go down, but the last few days we've really bounced off of that double bottom low point there, and you can see where we've got some resistance right about 90 1/3. That if we were to break above that resistance, which is also right about where the upper Bollinger Band is, then there's opportunity for a new trend to develop, for that exponential moving average to start moving to the upside. So that's definitely something to keep an eye on, because that would change the narrative. The narrative had been lower dollar, and that will help stocks move higher. Stronger dollar, we would not expect that same thing to happen. See, this whole time the dollar's been dropping, stocks have been moving higher. If we were to break that and start a new trend, even if it were just to go up to 94, 95 area, that wouldn't necessarily make stocks plummet, but it would pressure. It'd be a headwind for stocks to have to get through. Of course, there's a lot of factors that impact stock prices beyond the dollar strong or weak, but it's one of the headwinds or potential tailwinds, like it was here for the stock market as a whole. When you take a look at the the different asset classes, you can see from the bounce higher up through today's peak, right when the Fed minutes were released. You can see the tech sector doing really well. All these other sectors, consumer discretionary, industrials, financials, kind of matching. All your safe havens, especially your interest rate sensitive sectors, lagging, and of course crude oil lagging behind. From that peak that we've had in the S&P 500, and really about right there, let's go from the peak right there down to the downside. Look at that correlation. I mean, that's 100% correlation. Nothing really held ground. Consumer staples dropped at least 1.3%. The broad market was down 1.155% roughly during that. And you can see utilities and real estate dropping the most, which again you would not expect during the typical sell-off, because when interest rates are, those are safe haven areas. They tend to hold their value better, but with interest rates jumping as high and as hard as they are right now, I'll take a look here on the longer term chart first. I mean, look at that move. You know, this is high levels, very, very fast levels for the yield to get to. If you look at it on the Bollinger Bands here, take a look at TNX. Oops, TNX. Sorry. And then take a look at the weekly chart. Look at that. Look at the, you know, we're above the Bollinger Band on the weekly chart. We're above the Bollinger Band on the daily chart. You know, close to it. And then, of course, going back to that weekly chart here and looking at the 15 200-day moving averages. And you can see just how far up above we are. Now, you know, if I were to zoom out on this, here, let's change that time frame to a 10-year weekly, just for some perspective. As you can see, that was a strong run that we had here. We're making another strong run. Are we going to be able to get above that peak here? You know, if we push above 3% and this pushes above that, that's really going to be a headwind for the stock market. Really big, significant headwind. However, you know, if we were to continue to have some high rates and get up to 3% and mess around up here and potentially form this, you know, again, I'm talking about long-term view here. I'm not talking about just like what may happen over the next week or two. I'm talking about like the rest of this year. If we were to form this lower high point with a higher high and drop back down to 2.5, 2.6% in that area for the, you know, into the end of the year, then there is the fundamental basis from an intermarket relationship that would produce that good stock return for the year as a whole, despite the weakness we're seeing currently at the beginning of the year, as well as the increased volatility that's expected over the year. So that, you know, again, we might continue to have some volatility if we mess around. If we bust up through that, not a good thing. But if we kind of mess around and form that divergence, because it's obviously a much higher high already, and then pull back down to 2.5 the rest of the year, you see how it pulls back a lot slower than it jumps up. So if we're to slowly pull back to 2.5%, then we'll be fine. You know, that will be the tailwind for the stock market, you know, to get up to those double-digit returns that we were expecting based on how last year was with that lower volatility, as well as based on how the strong January that we had, the start that we had in January. So for today's trade idea, I want to take a look, since everything, you know, was pulling back here after the Fed minutes, one of the stocks that you know, closed below the low of its high day, below the last couple of days' low points, is Visa, closing below what appears to be a lower high across not just the price itself, but also the MACD, you know, here hovering at 0, and the stochastics potentially forming a phantom red arrow, where you essentially, it's when the stochastics turns down without getting into the reversal zone. Then you also have the Bollinger Bands here, you know, that have really widened out with the sharp pullback. But you notice as we bounced off of this, the lower band, we're hitting the middle band. We're hitting the middle line, the exponential moving average. This happens quite a bit where when you change trends, where you break below the moving average, hit the opposite band, bounce back up, you know, because we've been trending higher this whole time, bounce back up, and then roll over. You see here we hit the lower band, came up, and didn't, you know, hold that band for a resistance and roll over, and that's why the trend stayed higher. And you can see multiple instances of that. And you can also see too, when we go higher, it'll pull back to the moving average and bounce and continue the trend higher. You can see that there and a couple of times here and there. So that's going to be the case here. Are we starting a downward trend? Should we add something that's a little bit bearish to our portfolio just in case? And we just kind of hover around this area. And you notice, and one easy way to do that is to sell these options. In this case, we'll go out to April. We get a little bit of time. We get some premium because of how expensive the stock is. The spread's a little wide. So if I sold the 125 and bought the 130, you know, I'll have to fiddle around to see where I get filled in. The $1.16 is a 30% return on risk. That's kind of the target return on risk that we shoot for. If you were to get that $1.16, $1.17, you notice you get a pretty decent odds of success with your break-even price right here at this high, about 125. So there's the potential. You know, you know, if you were to get out of this, if there were to go back up, and you can see right above those highs, right about 127.5, you'll end up with about 100 and, you know, we're trying to get about $117 gain. You end up with about $140 loss, $117 loss. Again, on the green line, you know, is about right in that area. So that would be the difference. As time passes, the purple line will move up to the green line. So you're looking at, about 127 and a quarter or so when you get to a 1-to-1 return to risk ratio. Pretty decent odds of staying below that level, not including the fact that there's a high here and that we're potentially forming a lower high point and following this trend lower. If we were to break up above these highs and close and make a sharp close up above these, and that would be another signal that we could probably take even a smaller loss than that and just move on and get out of this trade and find something else to do. But again, it just adds a little bit of balance to a bullish portfolio, in this case with the posture of the market being weakly bullish, right? Getting above 50, but just barely, and expecting some near-term pullback. Near-term pullback would give us some time for this. And again, I don't expect this will get down below 110. That's why we're not buying a put. But if we stay down long enough for that that short strike at 125 to hold, in this case hold worthless, then we have an opportunity for a pretty decent probability trade here. So in summary, the market is got this tenuous bullish posture, barring what type of near-term pullback we get right now. And so the bigger the near-term pullback, more than likely the intermediate line is going to pull down. And considering the volatility right now, wouldn't be surprising if we don't get more of a pullback down. Not to lower lows from what we saw a couple weeks ago, but filling in a lot of that range definitely is a possibility. So, but again, that would be normal. It would be healthy, and it would set up for a better, more extended intermediate run based on how the charts are setting up there. So, as always, thank you very much for watching tonight. I do appreciate the time you spend watching these market outlook videos day in and day out, whether it's me, whether it's Brandon doing these. So thank you very much. Come back tomorrow. Brandon will be back on tomorrow with his take on what happens tomorrow in stocks. So be sure to tune in to that. And then I'll be back on Friday to close the week. So again, have a great evening, everybody. Remember to subscribe, like, and comment down below. Also remember to follow on Twitter for more content like this in short bite-sized quantities. And then, of course, join the Market Outlook community. Now it's almost 900 strong. So do that on Facebook. So as always, thanks. Have a great evening. We'll see you all tomorrow.